If you own stocks right now, this number should have your full attention. $1.3 trillion. That's the current level of FINRA investor margin debt. The highest ever recorded, higher than 2000, higher than 2007, higher than 2021. And yet, consumer sentiment just hit 44.8 on the Michigan index. Credit card delinquencies are at 13.1%, a 15-year high. The consensus says the economy is fine, and I disagree. Today I'm going to walk you through the data that changed my mind on the market, and by the end I will show you the one ratio that, in my view, tells you exactly where the symmetric risk sits right now. Keep the number 1.7 in your mind, I will come back to it, and it reframes the entire picture. Let me show you the full picture on this margin debt story. This is the same data, but with the complete historical context. Every single time this trend has accelerated to these extreme levels, a meaningful market event followed. 2000, 2007, 2021. The bull line is now above all three of those prior peaks. Now, here is what I find even more telling. When you normalize margin debt relative to GDP, you get a cleaner picture of structural leverage in the system. Margin debt relative to GDP is now at 4.09, above the 1 sigma band. This tells me that leverage isn't just high in dollar terms. It's high relative to the actual size of the economy producing the earnings that are supposed to back it up. And when I add the M2 money supply overlay, the picture sharpens even further. Margin debt relative to M2 is 5.64, the mean is around 3.8, that's 48% premium over historical norms. The shaded bands going back to 1997 show every correction zone. We are currently in uncharted territory, above even the worst of those periods. Now here is the nuance, and this is where the bull case has a solid point. Look at the yellow line. S&P 500 technology sector operating margins are at 29.4%. AI is genuinely driving record profits in the dominant sector of the index. The bears who ignore this are missing the forest for the trees. But look at the bull line, that's margin debt relative to M2, it's spiking just as sharply. The question I ask myself is the leverage growth proportional to the earnings growth? In my view, it simply is not. So we're getting to the part that surprised me most when I put up the data. This chart is from Goldman Sachs and FactSet. The median S&P 500 stock now carries short interest of 3.0% of market capital. That is the highest level since 2011. But look what happened the last time short interest climbed this sharply while margin debt was at record levels. It was 2007. The S&P 500 peaked in October of that year and then declined 57% over the next 17 months. But, and stay with me because this changes everything, in 1998, short interest also spiked aggressively. The outcome was the opposite. In late 1998, the Fed cut rates, liquidity flooded in, and the market rallied another 60% before the Fed reversed course. They hiked again and popped the bubble in 2000. So the pattern alone doesn't tell you the direction. What tells you the direction is one thing, whether liquidity is expanding or contracting. And that brings me to the most important signal in this market. The Federal Reserve just cut its reserve management purchases from $40 billion per month to $10 billion for the current period. That is a 75% reduction in liquidity support. The Fed ended quantitative tightening in December 2025, but they are quietly tapering the replacement program. But here is the variable that deserves more attention than it is getting. Look at this. The Bank of America Bull and Bear Indicator just hit 8.0. That is an official contrarian sell signal. Since 2002, there have been 17 such signals, and I'll be honest with you, every time I've seen this indicator cross 8, I've paid attention. Historically, global stocks averaged decline of 2 to 3% over the following 2 to 3 months, with maximum drawdowns ranging from 15 to 20%. I've spent 15 years as an investor and a trader watching these exact cycles play out. If you want to see these institutional shifts before they hit the mainstream news and before they hit your portfolio, hit the subscribe button right now. Let's get back to the data. But look at the component breakdown. Fund manager positioning is at the 95th percentile, rated very bullish. Cash levels dropped to 3.9%, which triggers a separate sell signal on its own. Now this is the chart I keep coming back to. Bank of America Global Research put out Exhibit 17. This is a scatter plot that maps long-term growth expectations against forward 12-month S&P 500 returns going back to 1986. Look where today is plotted. It is sitting in the same cluster as the tech bubble, December 2021 and early 2008. In every one of those cases, the next 12 months delivered negative returns. The data is telling us something. High growth expectations don't produce high returns. They produce disappointment when reality catches up. And here is another data point that very few people are talking about. This is Bank of America on table. Once CPI crosses 4%, stocks on average fall 3.5% over the next 3 months and 6.6% over the next 6 months. Look at the historical record. February 1934, August 1987, April 2021. The pattern is remarkably consistent. So if CPI ticks back above 4%, and there are scenarios where that happens, this table becomes very relevant very quickly. And here is what this all means in plain English. People are borrowing at a record speed, but the profits aren't keeping up for the broad market. FINRA margin debt relative to M2 is at 5.64%, well above the 1 standard deviation band, while broad S&P 500 operating margins sit at 13.1%. It is tech that is carrying the weight. This is the kind of structural divergence that historically creates the widest gap between prepared and unprepared portfolios. Because it is not just the US consumer. Japan is actively selling US treasuries to defend the yen. The USD JPY is back near the levels where Japan last intervened. That puts upward pressure on the US yields, currently at 4.5% on the 10-year. And when yields rise while leverage is at record levels, that's exactly when margin calls begin. And now look at this chart. S&P 500 called delta notional relative to market cap is at all-time highs. The mean since 2005 is 0.64. The current reading is at 2.81. So people are desperately buying calls, and that tells me more about the mood of the market than any other headline. Now, before I show you where I think this is heading, let me be fair and lay out both sides, because the one ratio I mentioned at the start only makes sense once you see the full picture. Here is the bull case, and I want to be fair here. Earnings growth remains strong and AI capex is accelerating. Tech operating margin is at 29%, and this is real. So that's not an accounting trick, that's a genuine productivity, and Goldman Sachs has raised their year-end target to 8,000. And the record short interest itself could fuel a squeeze that pushes prices higher before any correction materializes. I respect that view. Momentum could absolutely carry into Q3. And here is the bear case. This is where I personally lean. The Shiller CAPE is at 42, a level only seen in 1999. The Fed is reducing liquidity and consumer credit is deteriorating, but the biggest technical signal I'm watching right now is the measured move on the S&P 500. We've reached the projected ceiling near 7,600. In my experience, when a measured move completes on the top of these valuations, it signals a major market cooldown and momentum exhaustion. That's why the bear case here isn't just a warning, it is an asymmetric opportunity. And that's precisely why I was raising cash during the rally for the past months. So here's what I'm watching. The S&P 500 earnings yield is at 3.68%, below the risk-free rate on short-term treasuries, and below the -1 standard deviation band on this chart. The last time we were here was the late 2021. We all know what happened in 2022, and in my opinion, stocks are not compensating you for the risk. And here it is. The number I asked you to remember, 1.7. That's the Shiller price to earnings implied market return for the S&P 500. 1.7% annualized below -1 standard deviation. In my opinion, the weight of the evidence tells me the risk here is asymmetric. If the 10-year yield continues to grind higher and the Fed does not resume full reserve management purchases, the data historically favors a correction of 8 to 15% within 3 to 6 months. So if yields normalize below 4.4% and the Federal Reserve reverses course, the squeeze may continue. Personally, I'm not shorting this market right now. What I'm doing is holding cash in short-term money market funds while I wait for the setup. Dry powder, patience, I believe the opportunity will come. Watch the Federal Reserve statement on June 18th. That's your next data point. See you in the next one.